Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning and thank you for joining us on Trading Hour. It's 11 a.m. I'm Surabhi Upadhyay. With me is Prashant Nair, and it's turning out to be a Friday where the bulls are trying to wrestle some control back. Some of the bank stocks are still kind of sulking. We're absolutely close to the flat line for the time being. There's a lot of ground to cover. The bigger headline than these two indices actually today morning has been the rupee at 71. We will be talking a lot about all of these things as we go along. Good morning, Prashant.
Surabhi, hi. So yeah, I mean, breathless bull finally sort of resting a little bit, not necessarily a bad thing. By the way, for the week, we are still up 1%. So this is, I mean, gains for how many weeks on end? I think at least 6 weeks on end in terms of positive territory for the Nifty. So I mean, nothing to be really, nothing to feel sad about or scoff at. It's been a pretty strong run so far. Mid-cap index, small-cap index, I mean, the intraday charts or candles actually would convey the point better. They're both off the highs. The Bank Nifty is off the high quite a bit. And the Nifty itself, as you said, is down about 8 odd points or so. So that's where we stand at this point. Rahul Mohindar of viratech.com is now with us for a quick technical check of the market. Rahul, thanks very much. Morning. Your sense of things and what would you be trading?
I think the market's definitely taking a bit of a break. There is a congestion going on. If you look at the Bank Nifty per se, 27,950, very important support in the near term. I think once we break this level, we could have a bit of a collapse. Nothing's changed medium to long term. We're still in that solid uptrend. But the point is, you can't rule out a sudden sharp correction coming in. And I think there are a lot of pointers towards that starting to come up. Nothing confirmed yet, but an important level for me to watch would be 27,950 breaking on the Bank Nifty. If I look at the Nifty per se, 11,750, very severe hurdle. I think if these hurdles and these levels are kept in mind, one should be looking at a bit of a drop coming in.
Okay, so when you say a bit of a drop, I mean, would then, Rahul, that mean you're thinking of short positions in the indices? Bank Nifty's anyway been struggling this week. What about levels on the Nifty and the Nifty Bank that you would be watching?
As I told you, 11,750 is the key resistance on the Nifty spot, and I think lower down 11,550 would be kind of a target I'd be looking at. And again, this does not ruin the medium to long term picture, but I would certainly say that could be a meaningful spread for someone looking at the shorter term trend in this market. On the Bank Nifty too, yes, it's been struggling but not broken 27,950. I think the minute that breaks in, that's when you can start seeing a bit of a fall. In fact, I would say a stock like SBI would be on my sell list. I'm looking at targets of 295 coming in there. I'd keep a stop loss at 312 and go short on SBI. Clearly see that 310, for example, very severe resistance on SBI. It struggled to even stay above it in the last 10-15 trading days.
Okay, Rahul, thanks very much. Appreciate you joining in with those trades. We'll speak again soon. Krish Subramaniam from Altamount Capital is also with us. Krish, morning. What would your trades be?
Morning, Prashant. I think we have had a pretty, dramatic 1 hour of trading in the new series. So, I mean, one really can't be a very confident bull in this market. I mean, the way things have, the gains have got erased. So, Bank Nifty, I think it has been the shaky part in the whole of this week. And today's up move has probably just been one of those volatile moves which has got sold into. So I'm giving a bear spread in Bank Nifty. One could possibly buy 28,000 strike put and sell at 27,700 strike put. So net cost comes to about 74. Maximum gains will be 226. Recommend a stop loss of 50, and considering the fact that now the dollar is gaining some pretty good strength, one could possibly do a bull spread in HCL Tech. Now that has seen some very decent correction this week and now seems to be resuming its uptrend. So possibly a bull spread will be in order. One could buy a September 1040 strike call and sell a 1080 strike call. Net cost comes to about 19. Maximum gains would be 21. Recommend a stop loss of 10. And the last one is Bharat Electronics. Now, this had a terrific first half of the August series, but the second half it was languishing. It was consolidating. But I think closer to levels of 110, 115 enjoys decent support. So this could be possibly bought for a possible target of 125, but recommend a stop loss of 12 as well, 112 as well.
Oh.
All right, Chris, thanks very much. Appreciate you joining in with those trades at this point in time. Let's focus on the big story of the day, which is essentially the dollar rupee. Sajid Chinoy, Chief India Economist at JP Morgan, is now joining in from the sidelines of this CFA conference. Sajid, thanks very much. Morning. Should we start to worry a little bit? We know your views has been so far is good. The depreciation we've seen is not it's nothing to really worry about. No reason to panic, and there hasn't really been any panic. But as we are closer to 71, what's your sense?
I think we should just understand the global context here, that this is not a rupee-specific move at all. There are two parts to this. I think for most of the last 2 months, you had generalized dollar strength around the world. The dollar was appreciating against the euro, and that meant that most currencies came under pressure. What we're seeing in the last 10 days is something different. The dollar is not strengthened against other developed markets. What you're seeing is that current account deficit countries or emerging markets with current account deficit countries are having to pay a premium. So in fact, the depreciation in other markets, in Turkey, in Argentina, in Brazil has been much more, but nobody is really immune. India is not immune, Indonesia is not immune, even the Chinese CNY has depreciated a little bit. So this is a global move, and when you have these global moves, there is very little that one can do. I think what central banks can do is smooth the move, use your buffer stocks of FX reserves to smooth the move, and ensure that your macro fundamentals remain strong. Because when the stress settles down, investors tend to become much more discriminating. But I keep emphasizing we should not panic, because this is not India specific. It's happening across all emerging markets, and therefore you just have to weather this phase out.
That said, Sajid, you have in your reports argued that the rupee was overvalued for a better part of the last probably 18 months. Now at 71, is it close to its long-term RER average against those 36 countries according to trade weights?
Lata, I've been very careful to use the word overvaluation, because I think it's more art than science. What I will say is the underlying current account deficit of India has widened meaningfully the last 3-4 years once you strip out oil and gold, and therefore some calibrated depreciation would be desirable and healthy for the economy. I think it's important to keep in mind that the 6% real depreciation in trade-weighted terms that we've had in the first 6 months of the year was healthy. What you're seeing now is India just keeping abreast with other emerging markets. So in a way, if we're moving with other EMs or with trading partners, we're not really, the currency is not really depreciating in trade-weighted terms. What matters really for overvaluation or undervaluation is how are you doing in trade-weighted terms. We saw a 6% decline the first 6 months. The last 3 months were basically flat in trade-weighted terms.
Sajid, morning. So, if the 6% was, as you said, perhaps healthy depreciation, something that the economy needed, and now this move is more global in nature because nobody wants to sort of be close to currencies where economies have high current account deficits, then is this now the time perhaps for the central bank to start thinking, start using some of that ammunition that it has in its war chest? Therefore, I'm asking you whether there is sort of a level or maybe another couple of percentage points that you can tell us beyond which perhaps it'll be time to step in.
Well, two things to point out. One is the central bank has been stepping in. Our sense is there's been intervention all the way through. Some days more, some days less, depending on what the underlying flows are. But I think it's dangerous to target levels. I think in this environment, no central bank can artificially target a bilateral level against the dollar. I think economically that doesn't make very much sense, and that's not sustainable. I think once markets sense that you're drawing hard lines in the sand, these things are never sustained for more than a period of time. I think what's important, however, for central banks around the world is to allow two-sided volatility, so that if, once the stress abates and there are pressures for emerging market currencies to appreciate, that the rupee also be allowed to appreciate some amount, so that we don't get into this mindset of relentless depreciation, because that can become self-fulfilling like we saw in 2013. So I guess our sense is, allow two-sided volatility, which the central bank has been doing, and use reserves judiciously, given that this could be a prolonged fight for many months and quarters.
Okay. Well, I want two more quick questions to be squeezed in before you are taken away by your conference guys. One, later today is the big number, the GDP number. Our poll said 7.7% on GBA. What is your number? And what would you watch out for other than the GBA number?
Yes, Lata, we're in the kind of 7.5-ish range. Okay. Here's what I will say, that today is a healthy number. I think it confirms that we've had a nice cyclical recovery in the last few quarters. It will kind of soothe the nerves given all the stress around the world. But let's also accept that there are a lot of large favorable base effects that will push these numbers up. My sense is as the year goes on and those favorable base effects fade, growth on a year-on-year basis will kind of moderate. And again, that should not be alarmist, because just as for statistical reasons this number is low, you may get the opposite phenomenon in the coming quarters. What I would look for is to look at what we say is core GVA, that if you take out government spending, if you take out agriculture, what is the private sector momentum doing? What we've seen in the last few months is there's this divergence opening up, where the services sector is doing well, but industry, because exports have struggled, has struggled a little bit. So I'd be curious to see how industry stacks up vis-a-vis services in the private sector in today's number.
Okay, and finally, Sajid, just as you were speaking, and I think we should play those lines. Mr. Kanungo, the Deputy Governor, is speaking at a meeting, I think CII meet, and he's coming blistering on fiscal deficit. He's pointing out that state fiscal deficits have been repeatedly slipping. That's the RBI's observation. And even the central government only once in last many years had 3% of its fiscal deficit, has its fiscal deficit at 3% of GDP. So, it's coming down pretty heavily on fiscal deficit. And then you have this rupee at 71 and its concomitant impact. We just heard from our reporter that all detergent prices all detergent companies have priced up their products because of higher imports. So now, are you increasing the chances of rate hike in your projections? One rate hike earlier rather than later, or have you made that 1 into 2 rate hikes?
Yes, 2 quick reactions, Lata. I think the fiscal deficit is important for 2 reasons. In this very stressful global environment, it'll have a huge psychological impact if India can stick to its deficit. So I think the center should double down, and I'm hoping they will. The second is, think of where the pressures are. The pressures are on current account deficit countries. Ultimately, a current account deficit is investment minus savings. The lower our fiscal deficit, the higher will be our saving, and the lower will be the gap. So it's clear that India cannot finance a 3% of current account deficit in this environment. No country can. So we need to bring that 3% down in the coming quarters. And one key enabling mechanism will be if the center and the states can stick to their fiscal deficit targets. That itself will bring the current account deficit down. In terms of monetary policy, there are offsetting forces here. With rupee depreciation, there will be passed through into inflation, and that the MPC will have to worry about. That said, food prices seasonally are very weak. And my sense is we don't have all the data as yet, but when the August CPI comes out in September, remember, because of base effects, that was going to fall to 4%, and it's tracking below 4%. So we could be in a situation where CPI for August prints at 3.7 or 3.8. So the RBI is going to have these conflicting pressures where it goes into the October meeting with CPI declining, core momentum has come down, food prices are soft, but at the same time you have to look forward, not back. And against softer food prices is the fact that a weakening currency will impart some price pressures as well. So it's going to be a delicate balancing act. We currently have one rate hike in our baseline, but I think in this environment, 25 to 50 basis points for the rest of the fiscal year is what we're working with.
Sajid, just one quick last question from my side. One particular subject which has been addressed quite a bit by many in the recent past is this trend of falling net household savings, which we are seeing, and how this could become a concern going forward. I mean, have you done any work on this? What are we looking at? Should we focus on the percentage to begin with? Should we look at the absolute numbers? I mean, what's the right way to look at it?
Well, so I think, number one, these numbers bounce around a lot, so we shouldn't overinterpret 1 or 2 prints. But I think the larger point is the following, that savings are very pro-cyclical. And to the extent that in the last year, growth actually slowed, I'm not surprised that private savings, household savings would fall, because that's what happens. When you get negative growth, income shocks, savings follow that because you want to smooth consumption across time. So to the extent that GDP is forecasted to accelerate this year, and given the pro-cyclicality of savings, I would argue that private household savings will pick up over time. But I just want to come back to the centrality of this, given the external imbalances, which are the key constraint for emerging markets. Remember, the current account is investment minus savings. We don't want lower investment. We want higher investment. Household savings should hopefully pick up a little bit, but that needs to be complemented by lower government dissaving and keeping the fiscal consolidation on track.
Okay. Thank you very much, Sajid. Back to you guys.
Thanks, Sajid. Thanks very much. Thanks, Lata, for coming in as well. Appreciate you,
I just,
guys.
before we take the break, I just want to point out that the market is making fresh lows of the day. We should not take our eye off the screen. When we started the show, you remember we were at that flat line. Now it's a straight 0.3% drop. So there's some fresh selling that's happened. Banks should be pulled up, because that's where bulk of the weakness is. By the way, the strain on Yes Bank is really telling now. 6% down on that stock, so that's a newsmaker.
It's become a red candle now, which essentially means that the price now is lower than where it opened at. It's not still at the low. The low, I think, was it's just a couple of rupees away. But it's now, it's basically fallen. It gapped down, and now it's below that level, the opening level.
The other major stock, I mean, financials are overall weak. Your corporate banks like ICICI Bank, SBI, most of them are down. The big story is Reliance. Let's take you through that chart before we take the break. Reliance, after its massive rally, second day of selling, some kind of perhaps pause. That's a big fall on a very big stock.
Dipping about 27-28 odd points lower. And Surabhi was talking about Reliance Industries. I mean, the high on Monday, actually the high day before yesterday, because the third day of fall was 13.30. And the stock's basically fallen approximately 100 rupees from there, 12.45, and this essentially over the last 3 trading sessions flat. It is still one of the biggest movers this year. It's up 35% just this year, on top of the huge move that we saw in 2017. So you have to look at the cut in that perspective. Manisha is joining in as always at this point to discuss what's happening in the world of commodities and currencies. The focus is metals today. Manisha, morning.
Morning, Prashant, and thank you so much for that. Well, yes, we are reacting to the China data, and that is the reason you have seen the metal prices hold firm. The PMI data at 51.3 has beat the street estimates. Also, Beijing is ramping up growth-boosting measures. That is where the markets are taking cues from. What is not working in favor of the metals clearly is the China export orders, which have declined at the fastest pace since the month of Feb. What is also not working in favor is the US-China trade war intensifying, where US is almost sure of putting 25 to 10% tariffs on 200 billion worth of goods from China. So it really is contradicting fundamentals that the metals are working with right now. But overall, a bit of a support is what you can see. On a weekly and a monthly basis, we still are posting negative results here. But the data from China definitely is a bit of a booster here. Paul Bartholomew of S&P Global Platts now joins us to talk more about that. Paul, hi, good to have you. First of all, the good data from China, how are you reading it, and how much of an impact do you see it sustaining on the metal prices?
We still see the fundamentals sort of being okay in China. There's still a lot of talk of the trade war between China and the US, and we're seeing that impacting particularly things like copper prices, which have they've shored up a little bit, but still coming under a lot of pressure. But I think generally speaking, we've seen steel prices in China reach 7-year highs at the end of last week, and I think the feeling is, even though the economy is, I wouldn't describe it as flagging, but it's a little bit soft in the last quarter, there'll probably be enough activity, enough government stimulus going in, particularly in things like infrastructure. Property is still quite strong, to keep things at a reasonable level. We certainly don't see any great drop off in Q4. And of course, the other thing is China's ongoing environmental focus. So while it's keeping certain production and in check, particularly for steel, that's keeping things tight, and also the futures markets are responding to it quite positively. So it's it being okay in Q4.
But that's the China part. You also mentioned about US imposing or almost ready to impose further tariffs on 200 billion worth of Chinese goods. How much of an impact of that would we see? Because this now really seems to be intensifying.
Yeah, well, it's interesting because, in some respects, it seems to be hurting the U.S. manufacturers more than anybody, really. There's been the car makers, Ford and General Motors, have come out fairly recently and talked about the the additional costs that they're incurring now because of the because of the sort of steel import tariffs in particular. For China, China only really sort of, only comprised of less than 2% of U.S. steel imports. China doesn't really export too much in the way of cars or auto parts. So it seems to be sort of backfiring a little bit. Some of the U.S. steel makers, they're very happy because their steel prices are back at levels we last saw, before the financial crisis in 2008. But it's really the downstream people and consumers that are starting to feel the pain. So there's even already talk about possibly maybe just tweaking some of it. I wouldn't describe it as concessions necessarily, but
sure.
There's just some So we'll see, but it's still lots of things happening.
So what's your sense then? What would you want to pick up here on? I remember you telling us that the bulk commodities look good, so perhaps iron ore and steel, yes. But the other base metal prices, what kind of a future do you see with the trade wars, with how China is trying to push this on? What's the sense? What's the direction that the metals are going to take from here?
Yeah, each of them has their own sort of individual dynamics, as well as obviously in the wider context of the trade war. So things like alumina, there's a bit of a shortage at the moment, so we've been, see good support for alumina prices. With the Rusal effect is going to sort of kick in on the aluminium side from October the 23rd. But those two things together should support aluminium prices.
Okay.
But copper. That seems to be sort of hit harder than sort of anything at the moment, I think, because of the trade war. But steel could see it sort of coming off a little bit. Things like iron ore and coal, they've been sort of fairly range bound for quite some time, regardless of everything else that's been going on. But yeah, we certainly see steel staying relatively strong over the rest of over this year, even if it comes slightly down from some of the current highs we're seeing now.
Fair point, Paul. We'll let you go at that. So steel, of course, can continue to stay strong, but aluminum clearly seems like a favorite pick in metals.